So we're really excited to have Amanda Hahn and Matt McFarland here. They are the owners of Keystone CPAs, and also the authors of two books: the book on tax strategies for the savvy real estate investor, and also the book on advanced tax strategies. Welcome, Amanda and Matt.
Hello, hello.
Thank you so much for having us. Excited to be here.
We are so excited to have you guys. I was just telling Kenji that I remember reading your first book back in 2015. Like, we were house hacking at the time, and we actually made a practice of reading books out loud to each other. And so we were reading that book together and just getting really excited. Like, I still remember thinking about, like, oh, how am I going to write up our car? How am I going to do these bookend kind of weekends that you talk about, which I'm sure we're going to get into. So yeah, it's just really an honor to have you on here.
Oh my gosh, thank you so much for having us. And I think I need to implement that practice of having Matt read out loud to me.
These things are going through my head like, that's a terrible idea. That's way too much quality time.
Especially with COVID, huh?
Right?
Right.
Yeah, well, thank you for having us. We're excited to be here.
Awesome. So one thing that we really wanted to talk to you guys about is kind of hear more about your story, because you've really niched down to serving real estate investors at your CPA firm. And I know you have some background as well in your own owning your own investments. So we were hoping to kind of hear about how you started in all of this.
Yeah, it's interesting. So Matt and I took the traditional route, go through school, get our license, and we met each other actually working at one of the big four international firms back in the days. And happened to be, I was in the real estate specific group, and Matt was in the high net worth individual group. And lo and behold, those two groups have very similar clients, because a lot of the wealthy people are the ones who are doing real estate.
Mm-hmm.
And that's kind of where we came to the realization that real estate was a really great tool in terms of reducing taxes. It wasn't something that we learned in college through tax classes, but really just seeing it through what our clients were doing. And that's kind of what started us with the real estate investing bug of our own. We kind of, same thing, we started with one single family home. And I just remember being very scared with my first purchase. And from there, we just kind of built our real estate portfolio, and we realized there was a need for kind of more of the average investor who didn't have access to some of these strategies or more advanced strategies that were available to very high net worth individuals from, that the large firms were servicing. So that's kind of where we made the switch and decided, hey, we're going to take these strategies and bring it to kind of the everyday investor so they can use it and reduce their taxes.
Yeah, I remember there was, I talk about this sometimes, but like my aha moment when I was working at the big four accounting firm was, I was probably 2 years in, 24, 25 years old, whatever it was, and working on some 60-plus-year-old's tax return. Person's retired. He's got, I don't know, 5, 10 rental properties, but you're looking at the Schedule E, and you're like, okay, well, I can figure it. So you add back to depreciation. I was like, man, this guy's making like $200,000 of cash flow every year, and he's retired. And I was like, light bulb goes off, like, okay, this makes sense, and so yeah, it's from there, it's kind of tailoring the practice that we really liked real estate. And, I was very fortunate to work on, high net worth individuals, wealthy people that had various investments. I had, a couple of professional athletes, so that was fun. But yeah, real estate's just what we like, what we understand. It's kind of why we tailored our practice that way. So.
How awesome to have those insights from seeing other people's tax returns, right? That's an incredible, really luck in a way. That's awesome.
That's great.
So when you guys were thinking about starting your own business, were you scared? Can you tell us a little bit about how you decided to go out on your own? Because that's really a different path that you were on.
Yeah, it was interesting because I think a lot of CPAs, when they start out on their own, they don't really specialize. It's kind of like, yeah, we'll work with all kinds of clients and, just kind of get as many clients as possible. And so we were very deliberate in starting out that, ever since the beginning, we said we're focusing on real estate. And so it could be, a physician or an attorney or a financial planner, but the focus has to be that they're interested in real estate. They want to use real estate to shelter taxes. So I think it was pretty quickly. I think with any business, right? If you have a unique ability, you're focused in on a specific niche. Oftentimes, it's very rewarding, and so our practice, I think, grew fairly quickly because we were really hyper focused on strategies for this specific investment vehicle. But yeah, it was certainly scary, working in a big firm where we were before. You had all kinds of people helping you. We had a processing department, someone in a billing department. And when you're on your own, you're it, right? We were printing stuff ourselves, we were mailing things ourselves. And that was kind of a switch because we didn't have someone to, Paula to call and say, hey, can you mail this out? I would call Matt and say, hey, you got to go mail this out.
She'd call me from the other room. That's the craziest thing, right? Like, but yeah, no, it was. I know there's people that kind of consider leaving their jobs, and do I do it full bore, just quit and then jump right in, or kind of do it half and half, whatever, lack of a better term. But for us, it was kind of, we had the fallback of part of our work was still doing 1099 work for a local CPA firm. So we had some consistent revenue coming in while we're building the business. And for us, that works for us, just based on our personalities and our comfort level. Now, for other people, totally understand, like they can dive right in and go 120% and they can be comfortable and make it in 3-6 months and whatever. So it all depends on the person. But yeah, it was definitely scary, but it's, it was a rewarding experience. Like, you guys are working from home. It's just, it's all the time, but it's that you're doing it for yourself, right? So it has a different feel for it,
Yeah, it does. Actually, one thing that we talk about a lot is actually having a table and having multiple investment legs that are income streams, right? Yeah. That are bringing in money. And you guys already had that, right? You had your real estate already, and then you had 1099 work, and then you just built your business. So you already had 2 legs. You just added a third. So you had a lot of different income streams so you could survive. And I think that a lot of people think that they have to, like, for example, with real estate, that they have to quit and then do real estate. But actually real estate is so easy to just add in as another pillar, another source of income. And you don't actually have to change your day job if you don't want to.
Or if you have a spouse, your spouse could be focused on real estate, which is what I do. I essentially cut back on medicine. Now I just moonlight and I'm focused on real estate, and then Leti still practices medicine. I still practice medicine as well, but it just as a moonlighter. So yeah, so I think, a lot of people, just kind of think of it, like you said, I'll do one thing and then I have to quit that thing to do something else. And then,
right.
So
yeah, I think it's finding the balance that works for you and where your, risk tolerance is. And, obviously people have a lot more time on their hands at this point in time. So they could be doing real estate right now, like.
I'd love to hear about kind of like the book, writing the book, your first book, which, we tell a lot of our followers about your book, and we read that book ourselves. I mean, so, and it was with Bigger Pockets. I mean, was all that intentional, partnering with them and kind of writing the book? Like, was that kind of like part of your plan to grow your business?
Actually, no. So back then when we first did a podcast for Bigger Pockets, I didn't really know they were very big online. So it was kind of a blessing in disguise. It's, okay, another podcast, I'll do it. And so we started writing articles for them, very beginning before the company blew up. And I think what they really liked was our writing style. You can read a lot about tax strategies and tax savings, especially for real estate too. But I think a lot of people write in very technical terms. And, Matt and I, so we read all the time. We're always learning, even from other people, other CPAs.
Just not out loud to each other.
Yeah.
We will be reading out loud. And so I think oftentimes we read something, it's like, wow, it's very dry. It's very technical, a lot of code sections where, kind of the average investor gets lost in it and people just kind of tune it out. So we set out with the goal to say, okay, let's create something. We have so many clients and client examples of when things worked and when things didn't work. So I thought, those chicken soup for the soul type of books where it's just story after story. And we thought, okay, well, let's write a book, but with stories about taxes, and don't, try not to talk about codes and regulations, and just try to make it more relatable. And so we thought, that's, probably not too difficult. We have so many clients and so many good stories, as well as so many, not so good stories. And so yeah, that's kind of what got us started on the journey. Actually started writing it when we were on a cruise together. The two of us were like, yeah, let's just jot down some, of our favorite client stories, and it kind of just snowballed from there.
Yeah, we had a client once. He was reading the book, and we ran into him at some event. He's like, "Hey, I ask you, is this story about me?" I don't know what you're talking about.
Yeah, and changed his name, from Bob to Bill. But yes, that was him. He recognized himself.
I love that. I love the couple things there. That, I love the fact that you guys niche down. I mean, I think that's really a strategy for, that really separate really successful people from not. And then also the other thing that you kind of brought up there, which I loved, which we also incorporate, is that, you guys kind of like stepped away, you went on vacation, you cleared your heads, and then you kind of produced something, right? And that's something that we actually try to incorporate ourselves, is kind of take every year, take a few days off just for ourselves, away from the kids. And then it's amazing, like how much you can get done in that time, kind of planning and really just like, your mind just expands, because you're not, you don't have the everyday pressures and everyday thoughts, that are not going to necessarily promote creativity and like, expansive thinking. So I love that.
Yeah,
it's really cool.
And a great tax deductible getaway as well, right?
That's right.
Without the kids.
That's a perfect transition point. So give us some pointers. I mean, I have all these ones in my mind because you told such good stories in your book, but can you tell us some of the most common things that people who have real estate professional tax status, or who are just real estate investors in general, are missing in write-offs?
Yeah. Well, the one thing I want to start out with is, there's a misconception that if you're not a real estate professional, that you don't get a lot of the tax benefits. And that's actually not true. So regardless of whether you're a real estate professional or not, we all get the same tax deductions, right? As real estate investors, we are considered business owners because real estate investing is a business. And so we do get all of the you get to deduct all of the ordinary and necessary expenses of investing. So the only difference of whether you're a real estate professional or not really just depends on how much you can use in what year. Okay, so I think that's a common misconception. People will tell me, "Oh, well, I'm not a real estate professional yet. I'm still working, and I'm only doing this part time, so I couldn't deduct a home office, or I couldn't write off my car." And that's not true at all. Okay, so regardless, you can always take deductions for the money you're spending. But do you want to go over some common?
Yeah, I think the ones that get missed a lot are probably more common than people understand. I mean, it's, auto expenses, people, especially, the beauty of, obviously there's a convenience factor of working from home and having flexibility and stuff. But obviously from a tax perspective, the benefit of working from having a home office is that now your mileage, when you leave your house to go visit a real estate agent or go visit a potential tenant or, look at a property, all those miles are now deductible. Whereas, you guys know, when you were working for somebody else as a doctor, you leave your house and go to your, medical office or the hospital, those are all commuting miles. Those aren't deductible, so it's kind of like flipping a switch almost, is how you think about things and how you process things. So I think the auto deduction gets missed a lot. And that can just be even just taking the standard mileage deduction. And we've seen that add up to $5,000 or $10,000 of deductions, depending on how much people are driving, so.
Yeah, and I think, a good habit I always tell people to get into, right? If you're a real estate investor, or even if you're a physician, as a 1099, when you're spending money on something, ask yourself the question, right? Is this something that, would be ordinary as an expense for an investor or a physician? So even if you're at Costco and you're buying paper or highlighters, those kinds of things, right? Just put on, kind of have that in the back of your mind and say, okay, is this something that, would be necessary for me as an investor? And if the answer is yes, track those expenses, provide them to your CPA at tax time. Because the issue is, if you don't track those expenses, no one ever sees it, and that's an opportunity that's gone. And we know, especially for a lot of high income individuals, like physicians and other professional service providers, between federal, state, self-employment, payroll taxes, you're easily 40-50% in tax rates or higher. So even if you track $100 worth of expenses, that could be $50 worth of cash that you're keeping in your pocket, right? So it's very important just to kind of understand what are the deductible items. And if you don't know, that's what your tax advisor is for. I do want to just touch on briefly about, Matt mentioned the home office deduction. So that is an area that we still to this day have clients who tell us their CPA say that's not allowed or that's an audit flag. And that's absolutely not the case anymore. This was the case over 2 decades ago when people weren't really working from home.
That makes it sound old.
But the IRS has actually came out with easier methodology to claim the home office. Right now, you can take a standard per square foot write-off, and so you can see that their understanding times have changed. There's a lot of opportunities where people are working from home. I rarely have a real estate investor who rents an office space to collect rent and manage their finances, right? So most people are working from home, at least in the real estate space. So I highly encourage people to consider that. And, if you're a doctor, you have a physician's office, it does not mean you can't also have a home office deduction for your real estate business, right? So they're not exclusive of each other.
Mm-hmm.
And you mentioned kind of like, audit risk. And I think another maybe a misconception, and if you can clarify this, is claiming real estate professional status, does that increase your audit risk? I think we get that question a lot. What are your guys' thoughts on that?
That's a good question. So I think it depends. I've heard, people who tell me, yeah, my CPA said I definitely cannot claim it. If I do, I will get audited. And there's no truth to that at all. Now, of course, naturally, there are some people who have higher likelihood of a risk than others. So I think generally speaking, if you're someone who has a full-time job, or if you're husband and wife who have 2 full-time jobs, making $400,000 or $500,000 a year each, yes, if you're claiming a real estate professional, your odds of an audit is higher than someone else who maybe is working part-time, or one spouse is full-time and the other spouse is not working, right? So it's very specific. The risk level is specific to a taxpayer. But yeah, I wouldn't say that claiming real estate professional means an audit. The majority, I don't know if I want to say majority, but a high percentage of our clients claim real estate professional. We have very, very few audits on the tax returns we prepare. I would say maybe 1 audit every 2 years or something. So I definitely disagree with the statement of claiming it means you'll be audited.
Right. Okay.
Yeah, I think it's a matter of, again, it's like if you qualify under the rules and you're eligible to take the benefit, then why wouldn't you, right? Because it's about saving money now. It's about reinvesting that savings. If you want to put it back into real estate and continue to build your portfolio, it's just going to go a lot faster if you're taking advantage of the things that they put out there on the table for you versus, well, I don't know, I'm not sure about that. I'm not going to claim that. And then, maybe you get your benefits over 10 years instead of right away or something, that's obviously an extreme example, but it's just, if you're going to claim it and you qualify, make sure you got your ducks in a row. Obviously, make sure you have your documentation in place that if you do get audited, you can support that. Yeah, I spent X amount of hours on doing real estate and these are the things I did. And if I had another job, but this is my support for the number of hours I had on my other job, because I was actually, no joke, just this morning reading a summary of a real estate professional case where husband attorney lost the case. Now, he was an attorney. The wife was a stay-at-home mom, but he was the one claiming real estate professional. So I don't know, why that was the case, but regardless, he ended up losing the case because his documentation, his testimony, his support for all the activities was very vague at best. And then he was also making a lot of money on the side as an attorney. Now he was saying, I didn't do a lot of work being an attorney because of my health problems, but yet his income was just as much as previous year. So it's, it's all those kind of factors that, just have your ducks in a row and claim what you're entitled to, really.
So that does bring up how should people be documenting? I mean, what we've always done is we actually have a Google Calendar, and every time Kenji does activity, which is pretty much almost every day, he's putting it into the Google Calendar. And so he's updating that, almost every day.
Yeah. And so what I do is I'll literally say, okay, and I don't know if I need to be this granular or not, but I literally, if I spend 40 minutes on the phone or doing something, I will say, from noon to 12:40, I did this, and then in the notes of my Google Calendar, I'll just kind of write, kind of what are the activities I did. I'll reference an email that I might have written, a bill that I might have paid, whatever it is, I'll kind of document that. And so that's pretty much kind of where I keep a lot of my records, is in that Google Calendar, in supplement that with the emails that I receive and send from a business email that I've created.
Right.
But you're claiming you say you're doing this to qualify real estate. This isn't for Letty to double check that you've been working all day, or
No, well, that too, but I mean, it also helps for real estate professionals as well. Yeah.
two benefits here.
Yes.
Right,
No,
right.
I love that. So, that's probably more than what I think the average investor does, but that's a good thing, right? That's a good thing. If you're ever audited, that time log is going to be your insurance policy. Generally, from an audit perspective, what they do is they'll request your log. And from that log, they're not going to say prove every single thing. Typically, the IRS auditor will say, okay, well, let me pick 5 random dates, right? And so for those 5 dates, show them what you've done with the email and, the bills and stuff. And if you can prove that, most of the time, auditors are very reasonable, right? And they'll say, okay, great, I understand. That makes total sense. And they'll move on. If in those random 5 days they pick, you really couldn't prove any of it, they'll probably just choose 5 more and 5 more until they arrive at, yes, we believe you, or no, we don't. So yeah, I love what you said about the time tracking you're doing, because that is going to be the insurance policy if you were ever to get audited.
Now, just a caveat is, the only thing they talk about in terms of calendars is that those are so easily changeable 3 years later that you can go back and add something to a calendar that by themselves calendars probably aren't sufficient. But again, it comes down to also how organized somebody is. So what the IRS wants to see is that you're not using 5 different methods to keep track of your hours. You're being consistent and using the same one. So whether it's Google Calendar, whether it's Excel, whether it's paper, we probably have clients still doing things on paper. Whatever it is you're being consistent, you're tracking the same information, days, a description of what you did, number of hours. And like Amanda said, it's just, they're going to cherry pick things. And if everything looks like it's in order, they're probably going to move on very quickly. But if they cherry pick things and see that you've got 700 hours out of 750 all doing, internet research, that, they're probably not going to give a lot of weight to that, obviously. So it's things like that they're looking for.
Yeah, that makes sense. I can definitely incorporate a system where I just kind of PDF my calendar, all those dates and the information within those entries, and then that way I can kind of save it. And that, like you said, that way I can say I didn't add anything later, right?
Right. And I think the thing with the calendar too that they look at is that someone can always have something on the calendar but not actually have done it, right? So that's the distinguishing fact that, somebody can just load up their calendar and only have done one of the 10 things or something. So that's why sometimes they don't put as much weight to the calendar. Is what
For
I've
sure.
heard.
Interesting.
Yeah.
Okay.
Yeah, I think, obviously the benefit of the real estate professional is that it allows someone to be able to use their rental write-offs, losses, all the, the expenses to offset not just rental income, but also W-2 and medical income as well. And so I think, for people who are of high income, of high tax rate, this is probably the one main long-term strategy to, bring a tax rate from 50% down to 15 or even 0 taxes. And we have a handful of people, even in the medical profession within our client pool, that have been able to accomplish that. Right. But, it doesn't mean everyone's going to be able to achieve that in the first year, right? Like we're talking about starting off a business, if this is the first year we have 1 rental, you may or may not qualify as real estate professional, but if you don't, that's not the end of the world. We can talk about some alternative strategies to that. But the main goal is that in the long term, if our goal is to say, okay, we're going to build passive rental income, cash flow. If we don't qualify this year, maybe we'll try again next year, right? By the end of next year, maybe we have 5 rental properties or 10 rental properties. It becomes easier to qualify as real estate professional and maybe a larger tax deduction. So that's something we talk to our clients about. Don't be discouraged if you don't qualify today. We might qualify tomorrow, right? We might qualify in 6 months.
Yep. Makes sense.
Yeah, I want to go back quickly to talk about what you said about if you don't meet real estate professional tax status and you have all those write-offs. So what you get is those passive losses, right, that you're going to carry year to year. Can you give us some sense of what people use those passive losses to offset? What kind of passive gains do you see frequently?
Yeah, I think that is a common misconception of hey, if I'm not a real estate professional, I'm losing out on my benefits. Like Amanda said, that's not the case. So as you alluded to, yeah, you get to carry forward those losses if they're not used. And then you apply the rules the following year. You look at, okay, well, do you have any passive income to offset the losses against? And passive income, it could be net positive income from your rental properties, but it also can be net income you get from other investments. So maybe you're investing in somebody else's real estate deal that's kicking off positive income, or you're investing in a business and you're just a passive money investor and it made a profit. Those things where you're not actually involved in, you could use your rental losses to offset that type of income. Or when you sell one of the properties that the losses are attached to, if you sell it in a taxable transaction, so not a 1031 exchange, not a tax deferral, then you can deduct the losses that are related to that property in the year you sell it. So that's a huge thing that can come into handy for a lot of our clients that maybe they've been carrying forward losses, they just maybe weren't aware of it. They think that the real estate is such a great deal, but we can kind of run some numbers and say, well, you can sell this, not pay any taxes, reduce your taxes from your other income, and then you still have the cash to go and reinvest in potentially a better performing asset. Okay. And so that can be a way to utilize them too.
Yeah, that's definitely, that is actually one of the strategies we look at. If someone has a property, over the years, they've been carrying these huge losses, and, maybe they want to sell because now, they just don't want this property anymore. That's a great opportunity to free up those losses. In the year you sell it, it can offset W-2 income or 1099 income, whether or not you're a real estate professional.
What is that called when you do that?
I don't know. Is there a term?
No,
just freeing up passive losses.
Freeing up unused passive losses. I don't.
Okay.
Kenji and I met somebody who had $1 million in passive losses once.
So you might have to help them. We'll refer them to you.
Yeah. Well, we had a client recently that had almost the exact opposite. It was kind of, they were getting into real estate, but then they were generating like $1 million of passive income from K1 investments. Like, I think they were a doctor and they were investing in one of those doctor partnerships where they, kind of make money off of other people using the facilities or something. And
right.
I was like, okay, we gotta find you some passive losses. So we definitely see it both ways.
Interesting. So maybe this is a good time to talk a little bit about CARES and, what the really most salient points coming out of CARES you think are that people should know about if they're real estate investors.
Yeah. I think, so many things. We just did a 2-hour webinar on the CARES Act, but maybe some of the highlights. So I think first off, a lot of maybe people, our audience today, as well as people in our client profile that are like, there's the stimulus check, right? The economic impact payment, $1,200 a person, but I'm not even going to pay attention because I'm not eligible for it based on my last 2 years. One thing to think about is, right now we're still early in 2020, that there's still planning opportunities to be able to qualify for those, because ultimately that can be a credit on the 2020 tax return if your income was too high in the 2 previous years. And so, example might be someone listening today who's saying, okay, I'm going to, one of us is going to be a real estate professional. We buy rental properties. We do a cost segregation. We create a lot of deductions. And so maybe this year our income will be low enough so that we can actually get the stimulus credit, right? So that is still an opportunity. Just because you don't qualify looking backwards, you could still qualify with planning for the rest of 2020.
Mm-hmm.
I think the other big one that came out with respect to maybe physicians or just business owners who either own their own commercial real estate or invest in commercial real estate are the new bonus depreciation rules. Do you want to talk about?
Yeah, so a couple of years ago with the Tax Cut and Jobs Act, I can't keep all these names straight, but at the end of 2017, they kind of made the tax change. But one of the things they didn't change was they used to have this qualified improvement asset category that could get 15-year treatment, but then you could take bonus depreciation on it. That went away a couple of years ago because of somebody forgot to write a few words in the tax code. So they fixed that with the CARES Act. So now people that have, we'll call it non-residential property, commercial property, so retail,
medical
physician
buildings.
Physician office. If you do improvements to generally speaking, the interior of the property, instead of being treated as 39-year assets, which they were, now they can be treated as 15-year assets, which just by itself is better because you're getting double the amount of depreciation every year. But the other thing on top of that, the huge part about it is that 15-year assets qualify for 100% bonus depreciation. So if you have the right type of improvements, $50,000, throw a number out, you can take a $50,000 depreciation deduction in the first year you do the improvements versus spreading that 50 grand out over 39 years, which is almost nothing, obviously. So it can have a huge impact if for those people investing, like Amanda saying, commercial properties where they're doing improvements.
Yeah, we have a few clients. One is a physician. One is a dentist that made improvements back in 2018 when we filed the return originally. And so now you have an opportunity to go back and file amended returns to now claim bonus depreciation and then, create a refund, hopefully, in those scenarios. So that's a big one, again, for people who, either owner-occupied commercial property or investing in commercial property.
I see. So they actually fixed the problem. So they're actually going back to 2018, 2019. They're applying it.
Yeah. So that counts as it stands right now, counts for 18, 19, and 20. So you can go back and change your 18 return. If your 19 is not filed, obviously you can do it correctly. And then 20, you can take advantage as well.
Oh, that's huge. Yeah. For a lot of our listeners. Yeah. With medical practices, dental practices, that's great. Yeah. We'll definitely have to let them know.
Yeah. I think the other thing that we were, I know we were talking a little off air about was net operating losses. So real estate investors, whether, you're a real estate professional utilizing cost segregation, taking huge write-offs that are creating overall losses after they've been deducted against your other income. If you have these losses, now the IRS is allowing these NOL carrybacks again. So they were in existence a few years ago, but a couple years ago, they changed it where you can only carry it forward. But now they're saying now you can carry it backwards. So same theory, if you had a loss in 18 that you already filed and you carried it forward, you can go back and amend your 18 return and decide if it makes sense, run the numbers with your advisor. But if it makes sense, you can instead choose to carry that back to 2013 and apply it against income and taxes you paid in 13, and hopefully get a refund. So that's a nice opportunity. And that, again, is also available for the 18, 19 to 20 years. So they make you carry it back 5 years first. And then if you don't use it all, you carry it 4 years ago and then 3 years ago and so on. But
yeah, I think what I really like about these tax changes is a lot of those can be added one on top of the other. So we just talked about how, if you have commercial property, you can go take bonus depreciation. Once you take bonus depreciation, if you have a loss, now you take all those losses and then go backwards and claim an even larger refund than you otherwise would. So I think the government's doing a good job on that part in terms of, okay, let's try to fix what we did that was not necessarily right, but then allow people to use that to, get money in their pocket today, right, when it's needed.
Right. So I just want to ask a very pointed question. So let's say one of our students gets real estate professional tax status this year. They didn't have it last year. They didn't even own rentals last year. But if they create enough losses this year that they've sheltered their income completely, and then they have extra losses after that, can they take those losses and apply them to last year's taxes and actually get money back from last year's taxes that they paid?
Good question. So yes, if they created a loss this year, then the loss can be carried back. Now, it can't be carried back just to last year, though, because it's a 5-year carryback. So what they can do is they'll carry it back to the previous 5 years first, and then whatever's remaining, year 4, year 3, year 2, and then maybe last year's if they have enough losses. So yeah, there's a lot of planning opportunities still today. Like we said, right? Someone may not be a real estate professional today, but if they work on their plan and become a real estate professional by the end of this year, there are a lot of strategies that they can still use to create that loss and then carry it back and claim refunds.
But there's also opportunity as well, because it's not required to carry the loss back. So you can, looking at working with your team of advisors, if you know that 2020 is going to be a huge income year, maybe business is taking off or something,
21.
Or 21 or whatever, you can choose to carry your 19 loss forward instead. So you'd want to look at, okay, what tax bracket was I in years ago versus what am I going to be in coming up? Or with, stock market going down a little bit, maybe now is the time to people to look at doing Roth IRA conversions. Because, if it was, you were going to, would have converted 200 before, you only have to convert 100 grand now. Maybe you've got enough losses from these real estate or being a real estate professional, you can offset that if you do a conversion. So there's different ways to slice and dice it, but there's, so it's definitely, people definitely need to talk to their advisors. It's not a do-it-yourself thing, unfortunately.
Yeah, so that's a great point. Like, this is the point of why you need a CPA who's a strategist, not somebody who's just doing your taxes in a dark room somewhere, right? You actually need somebody who will look at your situation and talk through it with you and make sure you have the best plan to make you the most amount of money from, tax savings.
Yeah, and what people often forget too is that once you have the strategies, right? A lot of times the strategies can be utilized year after year. So when we say, okay, we're going to reduce our taxes with real estate professional, it's not just this year, because you can try to claim again the following year and every year thereafter. If we say, okay, let's do cost segregation. I love the concept of cost segregation for real estate because it's not uncommon. If let's say someone bought $100,000 building, right, with 20% down, which is 20,000 of cash. The first year depreciation could be anywhere from $15,000 to even $30,000, right? So there are things that could be done where you're writing off more than the cash you've taken out on making that investment. And those are things that are very specific to real estate, right? We can't really do that in the stock market or, bonds and things like that. But, those strategies, again, you can use year after year to try to shelter income. So I think, the higher income you make, the more important it is to have tax strategies, because you're not saving at 10, 12%. You're saving at 30, 40, 50% in taxes.
Mm-hmm. Right. And the more important it is to be a business owner, right? Like real estate, and not just a employee.
Yeah. And I do want to clarify, there's a myth when people say, well, we can't deduct these because we're not business owners, because we don't have an LLC or a corporation. And that's not true at all. So we have clients who own rental real estate in their personal name or in their living trust. They are eligible for all of the strategies that we've talked about today, whether it's home office or depreciation or real estate professional, right? So, there are reasons to have an LLC, for planning, for asset protection, but it's not a requirement to be able to receive the tax benefits of being an investor, because an investor is in the business of real estate investing already.
Yeah. So I think it's a kind of a good time to talk about your practice at Keystone CPA. Kind of where are you looking to take your business? How are you looking to grow? Can you tell us a little bit about that?
Yeah, that's a good question. I think
Well, we're limited by the space in our home office right here right now.
Right.
So
Okay.
we're not growing at this moment.
Right. Okay.
We've been fortunate because we have clients all over the U.S. And so we haven't really been, we do most everything electronically, virtually. And so our office as a whole, we haven't been too impacted. I know some of our colleagues are, they have to find space in their home to work. But other than that, I think for us, it's been business as usual. From a growth perspective, it's something that Matt and I visit every year too, right? We do the same thing you guys do. We take time every year and we kind of plan out ahead, and it kind of changes from time to time. But I think our practice still, as of now at least, is to keep it fairly small. We don't ever envision ourselves bringing on additional partners and having 100 staff, because I think at that level, we kind of go back to the old days of in public accounting where you lose touch with your clients. So we want to be small enough where we still know our clients, by name, kind of, okay, this person has 2 kids and what they have going on. So I think that's going to be the plan, because that allows us to be more high touch of a service rather than saying, who's this? I don't know anything about this particular client. So, but that could change, but that's kind of been our goal for the last couple of years, that when we do our own internal planning.
Yeah, but it's gonna stick with real estate. It's just it's like we enjoy it and we understand it. And could I learn what I need to know about a manufacturing client? Sure. I feel like I'm smart enough to learn what I need to, but why would I, then I would have to charge somebody to spend the time to learn it, and it just doesn't seem right, So it's like, I think we're pretty good at what we do, and I think the clients enjoy working with us, and so we're going to kind of stick with what we're good at and what we like doing, and and for us it's a lifestyle, probably for you guys it's a lifestyle thing. We have 2 kids, and it's we don't quite have as much time to focus on growing the business as we did 10 years ago before the kids came around, but we did a good job growing the business to a point where it's providing a good living for us and for our staff and our team. And so, yeah, we're pretty happy with where things are at.
Cool. Well, I'm going to say that, you're going to have to figure it out because I think you're going to get a lot more people coming your way. We're helping to create some more new real estate investors, and they're going to need good CPAs.
Who really
So
understand real estate.
yeah, for sure.
Right,
So
How
okay.
many units are you up to personally? Are you still owning your own rentals, and are you growing that?
Yeah, so our real estate, well, we have investment in Las Vegas and Texas. So I'm from Las Vegas originally. And so we have a good network there where, even through our family, that's where most of our properties are. Our California properties, we used to have California properties, but we've liquidated them in the past about 2 years. So yeah, we're always looking for real estate deals. I always tell our clients, we're kind of boring. We're the, long-term hold, cash flow kind of people. We have clients that do all kinds of stuff, Airbnb and wholesale and flipping and land development. But yeah, for us, that's kind of what we've been in the past. I am very interested in doing short-term rentals. I've seen some great success in our clients that are doing it. And just one real quick tip for any investors out there who are involved in Airbnb, if you can show that you materially participate in that investment, you actually could use those rental losses to offset W-2 and 1099 income, even if you're not a real estate professional. Okay, so that's something to consider. I'm not saying go out and do Airbnb, but that is something to kind of consider. And that might be something that we end up doing, in the near future, but we'll have to see about,
Yeah,
timing.
I think people misconception about short-term rentals or Airbnb, whatever you want to call it, is that, it's got to be in a vacation zone or something, and it's like, that's not even the case. I mean, even 4 or 5 years ago when this niche was taking off, and we were talking to a client who was in Las Vegas, and, as Amanda said, she's from Las Vegas, so we know the area. And you would think, okay, well, Vegas Airbnb, it's got to be on the strip. I was like, no, this guy's properties were 20 minutes from the strip, and his numbers, I was like, this is crazy. Like, you guys making money over money. And I talked to a client the other day that he has some short-term rentals somewhere in Oklahoma because he works for the Air Force, and there's an Air Force base there, and they need to provide short-term housing for all the pilot training center. And I'm like, what in God's name is in Oklahoma? Like, and he's making a killing off it, so it doesn't have to be a vacation, a mountain resort area by any stretch of the imagination.
Interesting. So actually, along the Airbnb line, we've heard different opinions on this, but what is your interpretation of if you're using your Airbnb, you're doing, like, I'm assuming you're saying Schedule C as opposed to Schedule E, and you're doing it that way. Can you use those hours spent on that Airbnb that you're treating as a business for real estate professional hours?
Yeah, great question. So you hit on probably a highly debated topic within the tax world, Schedule C versus Schedule E.
Right.
So, just real quick, if you show it on Schedule C, we're saying it's an active business, it's also subject to self-employment taxes as well. So that's an additional 15% tax. For the vast majority of our clients, we take the position that Airbnb, VRBO are Schedule E rental real estate, meaning we are not paying that additional self-employment tax. For us, the way we interpret the law, at least, is that it doesn't rise to the level of a Schedule C until you're providing hotel type services. And that's not, water and toilet paper. That's saying, okay, I will pick you up from the airport. I will take you to the airport. We have someone who's going to do daily cleaning. You can order food from us, like a bed and breakfast almost, right?
Mm-hmm.
So as you guys probably know, most Airbnbs don't do that. You get salt, pepper, ketchup, that's it. You're on your own. You
probably a little bit more than that.
Yeah. So we still report it on Schedule E, so you get the benefit of not having to pay self-employment taxes. But you're right, it definitely qualifies for real estate professional time. In fact, for people who don't have enough hours, that's one thing we talk about is, can you turn this property into an Airbnb? Because naturally it means you have to spend a little more time in managing this property, right? Getting it online, at least hiring the cleaning crew if you're not cleaning yourself. So the time definitely counts towards real estate professional status, regardless of whether it's on Schedule C or Schedule E.
Awesome.
So yeah, it might be more time self-managing it yourself, but like Amanda said, if you can do that and meet the definition of material participation, so that if you do a cost segregation on your short-term rentals, generate a loss, you don't have to be a real estate professional. You can still deduct that loss against your other income. So you kind of get the same benefits if, you know, you don't happen to be spending it, you know, 750 hours or more on real estate.
Got it.
Yeah,
Awesome.
that's huge.
Yeah,
That's
thank you
huge.
for explaining that. I mean, it's really nice to kind of have a very clear answer, and so I can understand why people
Are
enjoy it.
debating it, yeah, all the time.
For sure.
Okay, well, let's
Well,
go to our last couple questions.
yep, sure.
Yeah.
Go ahead. Yep. Go ahead.
So you know, this podcast is called Rich Doc Poor Doc, and so one of the questions we often ask is, what do you think makes somebody rich?
What's your definition of rich?
Mm-hmm.
I think for us, I mean, the definition of rich is freedom. So financial freedom, you know, the ability to not have to worry about day-to-day living and money, right? It's not defined by a dollar amount. It's more of a mindset. So, you know, we have, you know, we've met people who make millions of dollars every year who are not rich because they have so much debt, so many obligations. And then when it's tax time, they're like, wow, you know, how can I pay so much in taxes? I don't have any money, right? So that's the definition of not being rich. So yeah, for me, I think it's just, you know, the ability to live comfortably, financial freedom, more so than a dollar amount.
I think from outside of numbers, I think it's kind of like a lifestyle thing, like I said earlier, right? It's, you know, having the ability to, you know, be flexible and, you know, if you need to leave at 3:30, you know, to go coach your kid's baseball team, that your wife's going to let you do that, you know? So that's how I look at it, you know?
So it's having a rich life is rich.
Yeah, that's right.
That's all it's inherent in everything in life.
That's right. Love that. So then another question that we ask is, you know, can you give us a, you know, strategy, mindset, or habit that, you know, that defines a, you know, somebody who's rich?
You know, I think if I had to find kind of one characteristic in all, you know, rich or wealthy people that I know, I think there was actually two. One is to always be learning. What I find in that wealthy people, even if they're, you know, 60, 70, 80 years old, you can see them at the real estate event that, you know, they've taught at, but they're still taking notes and learning and asking questions. The other thing is just action. You know, I think wealthy people or just, you know, successful people, it involves taking action. So it's one thing to read and listen to podcasts or even, you know, engage us to do tax planning. It's another thing to actually do what you're learning, right? So
Awesome.
Yeah, I think a couple of things that come to mind for me is, I don't know, knowing when to, what you need to know. You know, when we work with clients, we don't expect clients to be CPAs, but the ones that seem to be more successful, the ones that understand enough to have that intelligent conversation that, you know, they're not spending 10 hours reviewing their tax return, but they understand enough about it, or they understand enough about their financial statements to have that conversation. And then but also to employ the people to do the things that you're not good at. You know, don't be afraid to have people help you, and don't get bogged down in trying to be a jack of all trades of the stuff that's, you know, learning the stuff that's not important in the big picture, you know? So unfortunately we have, you know, people who do that too, where it's just like, so, you know, I think that's how in my eyes, that's how I see successful people is, you know, some of those traits.
Yeah. Love that. Love that. So cool. So, so no, I really appreciate those answers. So can you tell us, as we wrap up here, can you tell us about your book, your new book, and it's called The Book on Advanced Tax Strategies, and tell us a little bit about, you know, how it's different from your first book.
Yeah, so the books are similar in that both are in story format, and so, you know, it's about client stories and the strategies they've used. The new book on advanced tax strategies is kind of, you know, the second edition, basically, right? Accounting 1, Accounting 2 type of. So in the first book, we talked a lot more about basic things like what to write off, and, you know, how do you write off your travel expenses and things like that. The second one, we're talking a little bit more advanced strategies on, you know, specifics about what can you do to claim real estate professional, or what can you do if you're not a real estate professional. professional and still take some of these benefits, cost segregation, 1031 exchange, and more creative real estate like seller financing or different ways to sell your real estate. But yeah, the formats are pretty similar. It's just the content is a little bit more advanced than the second one. So it's a little bit more difficult, I think, for us to write the second book, to have a more advanced topic, but not get technical and involve technical terms. But yeah, we had fun, writing both of those things.
Awesome. Yeah, we're really looking forward to checking that one out. So,
Yeah.
all right. Well, thank you so much.
Yeah, and maybe you could just tell people how to get a hold of you, and we'll put it in the show notes too before we close.
Okay, yeah, wonderful. So I think the best place is to check out our website, which is www.keystonecpa.com. That's KEYSTONECPA.com. We have a lot of free downloadable ebooks and resources, and we frequently do events like this one where we talk about tax updates. So that's a great place to start.
And I think there's a lot of stuff on there, like specifically now, there's a lot of stuff on there related to coronavirus and SBA lending and all those kind of programs are going on. So there's a lot of information people can get.
Awesome. Thank you guys again so much for being here. It was really enjoyable and a lot of good content.
Amazing. Yeah.
Yeah. So thank you.
Yeah. Well, thank you for having us. This was fun.
Yes. Thank you.
Thanks for joining us this week on Rich Doc Poor Doc. If you like what you heard, be sure to leave us a review and subscribe so you don't miss an episode. And if you want to learn the same strategies we use to achieve financial freedom in less than 5 years, sign up for our free mini course, The 4-Day Jumpstart to Real Estate Investing, at semiretiredmd.com. See you next episode.